Hey everyone, welcome back to Corporate Decoded, the place where we uncover the truth behind those cryptic corporate filings. It seems like today we are talking about separation maybe of shares, maybe of warrants. Something exciting is definitely brewing. So buckle up because we are diving into a recent announcement from General Purpose Acquisition Corp, or GPAC as they are known by their ticker symbol GPACU. This is not your typical financial report full of spreadsheets and jargon. This is a peek behind the curtain of a special purpose acquisition company, also known as a SPAC. These companies are essentially shell corporations that go public with the goal of acquiring another business. Think of them as a blank check company ready to find a target, and today we are looking at a report that details a significant move for GPAC. Its units are about to be split. This filing, dated the 22nd of January 2026, tells us that GPAC is making a change allowing the company's units to be traded separately as ordinary shares and warrants. This is a common step for SPACs, especially as they get closer to potentially merging with a target company, or as their initial public offering lockup periods come to an end. It gives investors more flexibility in how they trade their holdings. Right now, the units are known as GPACU and they consist of two parts. Each unit is made up of one Class A ordinary share, which is essentially a piece of ownership in the company, and half of a redeemable warrant. A warrant is like an option. It gives the holder the right to buy shares in the future at a set price. In this case, the warrants have an exercise price of $11.50. After this separation, the ordinary shares will trade under the ticker GPAC and the warrants will be known as GPACW. It is worth noting that GPAC is identified as an emerging growth company. This means they benefit from certain regulatory flexibilities designed to help newer companies get off the ground. They have elected not to use the extended transition period for adopting new or revised financial accounting standards, which suggests they are aiming to keep up with the latest reporting requirements. The core of this report is that starting around the 23rd of January 2026, investors will have the option to separate their GPACU units into individual Class A ordinary shares and warrants. If you hold units and want to trade them as separate components, you will need to work with your broker and the company's transfer agent, Continental Stock Transfer and Trust Company. This is important because it usually means the unit ticker GPACU will be phased out and replaced by the individual tickers GPAC for shares and GPACU for warrants. Keep in mind that you will not get fractional warrants when you separate units, so only whole warrants will be available for trading. Now, while this filing is more about announcing a procedural change rather than revealing deep financial performance, it does give us a glimpse into the structure of SPACs and how their units are packaged. For SPACs like GPAC, this separation is often a precursor to a significant event such as announcing a merger target. It's a way to increase trading liquidity and provide more options for investors as the SPAC navigates its path towards a business combination. The press release attached as Exhibit 99.1 elaborates on this update. What we are seeing here is the practical implementation of the SPAC's IPO structure. The units are designed to be a convenient way for initial investors to get involved, but as the SPAC matures, the individual components often become more relevant for ongoing trading and for potential investors looking to analyze the underlying shares and warrants. This section lists the securities that are officially registered and traded on an exchange. It confirms that GPACU, the units, GPAC, the Class A ordinary shares, and GPACU, the warrants, are all listed and traded on the Nasdaq Stock Market LLC. This is where you would find the trading activity for these instruments. Finally, we see the signature of Peter Georgiopoulos, Chairman and Chief Executive Officer of General Purpose Acquisition Corp, signing off on this report dated the 22nd of January 2026. This signifies the official release and acknowledgement of the information contained within this filing. So what does this all really mean for investors and for General Purpose Acquisition Corp? For one, it signals a move towards increased flexibility in trading their securities. This separation of units into individual shares and warrants is a standard practice for SPACs, and it typically occurs when the SPAC is either nearing its deadline to find a target company or when the initial lockup period for certain shareholders is ending. The opportunity here for investors is choice. They can now choose to invest in the company's shares alone or pair them with warrants expecting future upside. The risk for GPAC itself is that this separation might highlight the performance of the individual components. If the market perception of the company's future merger target is weak, the share price could decline while the warrants might become less attractive. If the exercise price of $11.50 seems too high compared to the potential future share value. In essence, this filing is less about dramatic financial revelations and more about operational adjustments. It is part of the life cycle of a SPAC, and it points towards GPAC potentially moving closer to its ultimate goal of acquiring another business. We will need to keep a close eye on future announcements from GPAC to see what target they might pursue and how these separated securities will perform in the broader market. Alright, that is our breakdown of General Purpose Acquisition Corp. What is your take on these moves and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.